So somebody asked, I think last week, about the debt and the interest costs of the U.S. And fortunately, this Congressional Budget Office and the CBO came out with a report this weekend, released yesterday, and the Pete Peterson Foundation actually put it into a nice chart form for me. So they let me have some more time for Mother's Day to share with my family. So today we're going to just review the government finances and take a quick look at the challenges that we're looking at presently and what lies ahead. As positive I'm about the U.S. economy right now relative to other nations, this is a sobering review that we're going to go through today. So you can see where debt is right now, and in 23. Federal debt held by the public was about 97% of GDP. It'll reach an all-time high projected by the CBO in 28 to be 106%, 116% by 2034, so 10 years out, and rising up to, as you can see, 185% of GDP in 2052. And I would suggest if we get there, we have really big problems. So I think there are some challenges that we can deal with in the near term, but as you'll see, we have to get our financial house in order. Annual deficits are a very significant percentage of GDP, running around 6%. And how that is controlled is going to be a big issue. The deficit number is going to be staggering. They're looking at $5.4 trillion deficit in 2034. Now, obviously, we're going to be on a much bigger economy at that point and all that, but these numbers are not that great. But this is one of the big ones, and interest costs rising. We know that the problem that exists, seeing it go from where we are today at about $860 billion, passing where defense spending is on its way to $1.6 trillion. And if you just think about that, if it was a household or a company, these are not the numbers that get you moving in the right direction or allow you to make the investments that you need. So where we were just talking about the fallout of the solar system and what that could do to the power grid, where's the money going to come from? And if we have interest costs crowding out other spending, that's a big problem. And here you can just see how the net interest costs are projected to rise, and that 10-year total of $12.4 trillion is what they're projecting for the interest costs to be cumulatively during the period from 24 to 34. So not a great look there. And as you can see, at 16, we had a deficits of net interest costs, of only $232 billion. So we're really moving in a bad direction there as well. And this is based on the CBO's projection that the 10-year Treasury will be at these levels. And as you can see, the way they're looking at it is the 3-month will be stable in the short term, then drop to about 2.7% in 27, and then flatten out from there. Where they have the 10-year, which will increase to about 4.8% next year, and then decrease to 3.7 by the end of 2026. And then rise back up to around 4.1% at the end of the period in 2034. Those levels of interest rates are not in and of themselves particularly bad. It's just the level of debt that we have that makes them challenging for where we are. And it shows you the impact of what the zero interest rates and the low interest rates that we had done for us. And while we are now putting a lot of money into the system to deal with the problems that we had, wouldn't it have been better if we started back in 2009 when we first took rates down to near zero, or in 12 or 13, instead of doing it when we were just about to raise rates up from 0 to 5%. So as you can see, we have other entitlement programs is a big part of the problem. And as you know from our two fine candidates, current president and the former president, neither intends to touch the entitlement programs, which are projected to run out of money sooner than was expected. And then you add to it the Highway Trust Fund, which is an important element, which is under a lot of pressure with the move to EVs as well, and the underfunding that's gone on there. That's projected to be depleted by 2028. But important on this chart is the net interest line, which is rising at a very fast rate, much faster than the other costs, which are still high, but not moving up quite as much as they've been. So this is a big problem. When you're looking at this now, this is the amount of spending on these three programs is almost 20% of our spend going to these three areas. And that's going to crowd out a lot of the other investments that we need to make in the system. I think this is one of the big challenges that the US government and other governments around the world are facing. There's too many problems to solve and not enough willingness to do it. And that leads to the other problem is it would be fine if the revenues were going to be there, but the revenues are not projected to rise enough to get us there. And this takes us back to what we learned back in 2010 with the Simpson-Bowles report, that the projection for the US, the rate we were going, the taxes were too low, and the costs and the spending was too high. And we had to do something about both of them if we wanted to get serious about dealing with the deficits. And we've ignored it for all these times and actually have lowered taxes and increased spending since then. So you can see where we're going here is a bit problematic. Adding to that problem is the fact that you have the sunsetting of the Trump tax provisions coming, which could lead to about $2.6 trillion of increased costs that we're going to be facing as well. So you're looking at a system that's not really in great shape in the longer term. We can deal with it in the near term, but I think this counters some of the idea that modern monetary theory is good, even though it's worked in the short term. I think people should be careful thinking that it worked forever. It's an experiment. We're going through a massive economic experiment. We have been for the last 15 years with quantitative easing and zero interest rates and negative interest rates. I think we have to be careful thinking we know what the outcome's going to be. And I think we can't be complacent about what's gone on in the recent period because things are doing okay. But we have some pretty big deficits that we're facing. And if we don't get those in order, we're going to have some big problems. Now, Ferguson has a law that says any great power that spends more on debt servicing than on defense will not stay great for very long. That is where the US is moving to. And I think this is one of the things that we need to be aware of because I think the defense spending is going to have to remain somewhat elevated for an extended period because of the changes in technology and the changes in defense. We're moving into space with defense, cybersecurity, and other areas. Defense takes on a different meaning today. It's national security more broadly. And I think we have to think differently about our spending around the world. But this is one of the big issues we're facing. For all our problems, the US does remain a standout economy, but it's not guaranteed to continue to be that. This is a chart of GDP outperforming the G7 nations from 19 to 24. Surprisingly, inside Europe, with Italy making a reversal, Germany going the other way. I think this is a kind of a sign of the times too. While Italy had a lot of problems with the financial crisis, they did some steps to get their financial house in order. I think other countries need to do a better job of that, the US being one of them. And I think one of the big issues that's coming our way is financing the debt. And I think the move by Janet Yellen last month and the Fed to coordinate lowering the reinvestment of Treasury securities, the quantitative tightening by a bit is going to actually help offset some of the squeeze that might have come from a buyer strike. There was some concern about foreign buyers not coming in. I would say what's interesting is, and Ed Yardeni had a nice piece on this today, while foreigners, China and some of our adversaries might be trying to sell their Treasury positions down, and as I mentioned on the last call, I think China's around 775 billion as of the end of March in Treasury holdings. When you've moved from 0 to 5% interest rates, you've brought back buyers into Treasuries from the US that include the people living on fixed income who need that kind of return, that the more steady, stable 5% returns. You're seeing insurance companies who have been starved to get yields on their bond portfolios now going back in more aggressively. You're getting corporations doing it. Hedge funds are moving into the Treasury area as well with the types of returns you're getting. So I think in the near term, we're going to be okay on financing the debt. just the move by the Fed alone of reducing the quantitative tightening is going to require the government to fund to almost $300 billion less this year of Treasury issuance. So those things will all help. So I think it's one of those periods where in the near term, we don't have a major problem. But if we don't get our house in order, we don't get our spending in line, get our taxes in the right area, we're going to have some problems. And I think if you go back and look at the Simpson-Bowles report, which was a bipartisan report done quite well, they laid out some really sound thoughts on what we need to do there. Cap government spending at 21% of GDP, reduce mandatory spending, reduce spending on federal health care, make Social Security sustainable. The average life expectancy has changed so much, we have to do better there. And yet people want to work fewer years rather than more years. We're going to have to do that. And many of the tax loopholes that, so the government could cap revenues at 21% of GDP and lower taxes at the same time. And then there's a series of reforms that they put through. I think if we go back and look at that report today, we'll wish we took a lot of those the things we needed to do back then and put them in place. We wouldn't be looking at the deficits we have today. We would have had lower deficits. We still would have had a higher problem because to deal with the financial crises we've had, the wars and the like would have changed it. But I think we are in a different spot now. And I think people have to get their minds around the fact that if we keep going down this cut taxes and increase spending approach, the U.S. will not be one of the world's leading economies. Others will step in. Others are having those problems, similar problems right now. But we have to get our house in order, and so does, and that's really what we should be focused on. Congress is really missing what they should be doing here. I would just close with, we're in a period of massive economic disruptions and distortions, but they are creating big opportunities, but you have to move away from the crowd. And there's a lot of money chasing a few areas. We see a broadening out going on in the markets that is quite helpful right now, and creating some nice opportunities to make some significant capital. The materials sector significantly underweighted. And if you think about the tariffs that were put through today by President Biden, which were the same ones that similar to what President Trump would have done, I think you're going to see the impact on the materials sector. Some of the domestic companies in that area will have a pretty significant impact coming. I think there are other changes that are going on that are going to have some big impacts that we can take advantage of, but they're not the obvious opportunities. I think, Janan, you were mentioning getting our transformers built. That requires a lot of materials to get our grids up to speed. It's going to use massive amounts of steel, copper, and other materials that we have been importing, a lot of them. And there is a race around the world to secure the supplies you need. And yet the materials sector is only a couple percent of the S&P weighting. So people are significantly underweight that area. I would also just highlight one other change that I think is going on, because while I have been negative on Europe and China from an economic perspective, I think there's something going on there that is part of the divergences that we're seeing today, where the US is going to hold rates higher for a little bit longer, and the UK and other European nations are lowering them, as is China, which will make their multiple expansion a possibility there, more so than it is in the US, and may make their equity markets a little more attractive. I also think the lower interest rates can just help boost the economy and stimulate some economic activity for them. So I think there's some interesting opportunities. Whether they're long-lived or not, I would leave it to you guys to figure out. I don't think the differential will stay that long. I think we will be cutting later this year. But I think there is an opportunity in the near term to take advantage of some of that for the more higher quality companies. The debt servicing and tariffs are going to become bigger issues, and we have to think through what that means for individual portfolio holdings. But I believe we've moved into a period where strong balance sheets and free cash flow are going to be maybe the top characteristics you're looking for in companies right now. Obviously, growth and all that is going to be important, but the ability to make the investments in AI, the ability to make the investments and deal with the higher costs that might come from some of these transitions and tariffs in the short term that may stimulate the economy longer term or help the U.S. manufacturing or help national security are going to be problematic for companies, particularly those struggling with their debt burdens already or with weak balance sheets and with low free cash flow. Because if you're not making the spending on improving your productivity now, you're going to be left behind. So a lot going on. It's not a positive long-term picture for the U.S. I am more positive on the U.S. than other nations in the short term, and think we will continue to attract capital for a lot of the underlying factors that the U.S. continues to be so strong in. But this is a changing world, and it's changing at a pretty aggressive rate. And I think we have to be maybe a little bit more on guard than we have been in recent times about liquidity and shocks coming to the system. So, Mark, I'll stop there, and we can open it up for debate and discussion.
Well, Mike, thank you, Stephen. Mike Dale, you had your hand up early on,
Yeah.
so go for it.
Thank you. First time ever. Thank you, Stephen. I may have misheard you, but you mentioned the expiration of the 2017 tax cuts, and you mentioned a cost involved. Did I hear that right?
Yeah, the projection is that and other things that are sunsetting would be about 2.6 trillion, I think, is the number that they're projecting.
But what 2.6 trillion is what?
Is the expiration of the tax breaks that you were getting under the Trump tax cuts.
Okay. So for the feds, that's increased revenue.
You're going to, yeah, in theory, it'll be increased revenue as well.
Because you cited, we cannot continue to cut taxes and increase spending in the long run. That doesn't work.
Yeah.
So
yeah, I think we need. I think Trump went too far with his tax cuts. If you go back to at the time, he was talking about taking it even lower than 21%. But the OECD average at the time, I think we were at 35% or 34% before he was elected. The OECD average was 25. So if we just went there, we would have leveled the playing field. We didn't need to go 4% below that. It was unnecessary to be competitive, which is the reason you level the taxes.
But I think you cited it once before as passing the bill to our grandchildren.
Yeah, we said we like to say we're sending the check to the kids' table.
Yep.
What we're doing.
Thank you.
It's problematic. I think Adam was next, Mark.
Yeah, I was just imagining my kids getting the check. Go ahead, Adam.
Good morning, Stephen and everyone. Thank you, Stephen, again for the presentation. I have two quick questions. The first one is the aid to Ukraine, Taiwan, and what have you. What impact does that have on U.S. manufacturing and inflation, given that most of that is really money that's going to be spent in the U.S. armament? My second question is the mining sector. You had mentioned copper and other, well, it's not a rare earth, but other minerals.
Yep.
And that's going to be needed for EV and rebuilding our grid. What are your thoughts on investments in that sector, in the mining sector? Those are my two questions. Thank you.
I think the aid to Ukraine and was it 52 billion or 62 billion or something?
61.
The overall scheme of things is a rounding error for the U.S. the way we're throwing money around these days. So I don't think it's going to be material to the problem that we're looking at. And I think the bigger issue is, why did we wait 3 months to approve something that we were going to eventually approve for military reasons and geopolitical reasons makes no sense. It also just makes the cost of war more expensive because we're further behind. So stupid kind of approach there. But I don't think it's a big impact. The second part, we favor the U.S. steel makers because they're going to benefit. A fab requires, I think, 75, one fab. I should have this number off the top of my head because I'm writing about in our next Outlook, requires, I think, 75,000 tons of steel for one fab that we're building in the U.S. today. So you think about that, our steel producers, total combined market caps, the top 5 steel producers is under $60 billion. So it doesn't take much money moving into those areas to stimulate it. And part of what he was putting the tariffs on was steel. The other was batteries, which gets into the rare earth area. And then there's a fight going on for copper resources around the world. And that's getting a lot of press. Every major nation's chasing the same assets. So I think we'll see that continue. So it's copper, steel, or the big ones that we're focused on, in the rare earths would be the 3 ways we're playing it. And they're undervalued assets in our view. That I think Cliffs Resources had 11 price increases last year. And they've also gotten money from the government to use hydrogen in their production of steel. So there's a greening going on with these guys as well that I don't think they're getting credit for, but is going to be, there's a lot of positive things from an ESG perspective that the people everyone hates are doing, whether it's the steel companies or even the energy companies now. It's pretty interesting.
Thank you, Stephen.
Right. Stephen Keys, and I have to thank you for doing your survey. I can't thank everybody on here because they're not doing their surveys. So please, survey 16, it's in the chat.
All right, simple question. Do you think, Stephen, that it's feasible for the US to eventually move or adopt a gold-backed currency framework instead of fiat money as you have it going right now?
I don't know. I would leave that for someone smarter than I, but I would think the train left the station if I had to guess. And it would be a guess. Not well informed either. By the way, Stephen, Canada's got some challenges of its own these days that we need our neighbors in the north to get things turned around.
Jesus. Yes, it's so good that I moved out. I'm in Mexico now. So it's beyond recoverable. I have nothing but the saddest. I have no hope for Canada. I think they've turned a corner, and it's going to be hard to come back from a reputational standpoint at the investment level. It's just horrendous what's going up there.
Be interesting to see if Stephen Harper is elected as the.
You mean Pierre Poilievre? Harper was prime minister 10 years ago.
Oh, not Harper. The central.
Yeah,
bank.
he will. Whenever that election comes on, he'll be elected. That's guaranteed. Every poll says they're going to be liberals are going to be obliterated. It's just that they're clinging to power for another 16 months, right? Which is just appalling. It's just where they're digging that ditch to a depth that's never been seen, and I don't know. It's just
Okay.
To me,
It's a trading partner for the U.S., so we need to keep an eye on it.
Next subject, Roger.
Hey, Stephen.
Hey, Roger.
I'm not sure if I missed it on the first couple of slides on your deck on the U.S. government debt. Do you have one that shows what percentage of government spending is on interest and how that is projected over time?
Yes,
I mean, as a percentage of. Oh, did you have it in this slide or?
Yeah. Yeah.
Oh, sorry, I missed it.
It was in the. It was with. It showed all this big spending programs. So let me get to that. This one, and it's this line here, Roger, starting in the lower left corner, and sliding up here is our net interest cost rising.
Okay.
As a percent of GDP, it's rising from about 3 now to 6, projected in 2054.
From the lowest to the second highest, effectively.
Yep.
Okay.
By the way, Roger, I was with Jim Pallotta, who also founded and Jack a squash program for inner city kids in Boston.
Oh, good for you. I was just on to Jack. Jack on. I was just on to Jack a couple weeks ago.
Jack's on.
I feel as though I'm on.
Bill Deichler, you came on. You want to say something?
I was just gonna. Is that Jim Pallotta from Tudor?
That is Jim. That is Jim Pallotta from Tudor.
Right. I was just gonna make a note. with regard to the conversation that Stephen brought up as far as Canada, I was up in Toronto last week at a private credit conference, and it was very interesting. Sort of the dour feelings were circulating around there as well. Someone actually even mentioned 50-cent Canada dollar to US dollar, which was stunning to me that someone was even thinking about levels of that range. Does that jive, Stephen and Stephen?
I would be shocked if it got to that level, to be honest with you. I don't know what the low is, but I thought the low was around 60, 71 or 68, somewhere around there. I don't know the exact number, but that would be, I don't know what would happen. I don't know how you'd want to think about that if it got there.
Yeah.
We're at 71 cents right now. Basically, we've been at 70 cents on the dollar for like 4 years.
Yeah.
So if it moved that, and that's with the problems, if it moved down below, much below that, I would be, if it got, I don't see it going that far down. I don't know what they're looking at that would get it there.
Yeah. Yeah, it's, I was, last week was busy for me as well. I was at yet another event in California, and Jeff Gunlock was speaking there. Very much the same data that you presented, Stephen, was stuff that was coming out of him. And, once again, nothing like putting a wet blanket or the famous quote, inviting a skunk to the party. I continue to think that the best way out, and perhaps maybe one of the more difficult ones, is to be able to grow ourselves out. And, thinking about that from a thought experience, or sort of a thought process, I think we'd have to be, going to lower taxes, and hope that the economy, responds appropriately to that. But I think that's a tough go as well.
Well, I think Simpson-Bowles was trying to get there with the simplifying cleaning up the tax code and just simplifying a bit. But we know that that's a problem that we don't have anyone who wants to try and attack because of the special interests. So I'm not quite sure how you get there, and bring down costs at the same time.
Historically, though, Stephen, do we have any data apart from the hold on a second, it would be the 80s, no, the 90s, where lowering tax rates from the 80s caused an economic boom in the 90s that kind of proved the theory that we could grow our way out of the debt issues? Any period apart from the 80s and 90s that suggests that theory is actually correct?
Well, I think the theory was correct then. I guess I don't know that you can take that environment and overlay it on this one and say you'll have the same outcomes.
That's my point. That's exactly my point.
Yeah,
because I think most of the economic, as an economist, most of the economic growth theories will tell you have to increase productivity. You can grow your way out of it marginally, but productivity is how you kind of get out of this problem, increase in productivity.
Absolutely. Yeah, we have to do more with less. That's it in a nutshell. And that when we keep doing the opposite, we do less with more.
Because I would argue that the extremities of the taxation, the high taxation rates coming out of the late 70s, Reagan lowered it, and the regulations in the 80s caused the boom in the 90s. That's kind of the prevailing theory. But there were such extreme levels that you were able to kind of grab low-hanging fruit. And therefore, that theory worked then. But to your point, I don't think it can work with this economy now.
Well, just Roger, one point on that before we jump off is that we were taking high cost manufacturing and exporting it out to lower our costs considerably, which made us more productive, but we found out the cost of that later on. So I think and we did that to offset the rising labor costs because the unions were having guaranteed increases throughout that period by law. So I think or by contract. So I think it is a very different scenario, and I do think productivity will drive it. I don't think you have the easy money, the easy opportunities for productivity enhancements right now.
Yeah,
that we have back then.
So Joe and Chaz.
Stephen, thank you for the.
Sorry, Chaz. 1 second.
Go, Joe.
Although Joe, you've spoken, so maybe I'll if you want to defer to Chaz, it's your call. Chaz, go ahead. Sorry. I'll take that back.
Thank you, Stephen, for the presentation. And a couple of things on political will and then on the healthcare spend. We've had some rumblings lately about potential tax increases coming out of the Biden administration. Does the story you just portrayed in the deck, is it stark enough to shift political will around tax increases? And related to that, and Mark, I don't know if I can conduct a quick survey. Would the Americans on the phone here be open, or would they be supportive of tax increases in light of the story Stephen just took us through? So that's one. And then the second question is on the healthcare line, which, you know, it's the highest cost category, which you would think would be also the greatest opportunity for managing it down, given that drug costs around the world are so much cheaper than they are here in the US. And the fact that healthcare access seems to be on the decline as opposed to increasing. So there's something about that spend line that suggests to me that there's opportunity here that Congress should be able to begin to manage that number down. And I know private equity, we're seeing an increasing force of private equity in the healthcare spend, which would probably be more inflationary around the cost of healthcare than just the opposite, based on what we're seeing in private equity healthcare portfolio performance. So those are the two items, Stephen. Thank you.
It reminds me of what Reagan said. We're from the government. We're here to help. We're a hedge fund. We're here to help lower healthcare costs. I would say that I think healthcare is a big opportunity, and AI is one of the ways to get there, because we can cut the cost of time to produce the results we're trying to get and get better outcomes faster. But I think we have a demographic issue that's not very favorable too, that we have to keep in mind. The way you build GDP is through population growth and productivity growth. And we're working on one side of the ledger pretty well. The other side of the ledger is a problem, and that gets to what we're doing on immigration, as well as our fertility rates, which we're not going to solve fertility, so we can fix it with immigration if we wanted to. Regarding the political will, I think this is a hard time to get through those things. And I think it's fascinating to me, the policies that both are talking about are not the policies that either party was founded on. They're taking elements from the other guys' platforms and kind of mashing them together. And I think voters are not even sure who they're voting for or what they're voting for in terms of the old platforms these days. So I don't know how they would, I don't think that would sell. No, is the answer on that one.
So back to you, Joe.
Well, I'm such a fan of Steve's work. I think there's such pearls of extraordinary wisdom in it. And the thing I would, I guess, characterize is when you're thinking about the opportunities, I think you have to bifurcate between a trade versus a real investment, which has a longer duration and a longer expectation. And I believe that the investment thesis is not that hard, but it's also not comfortable. And that is what Stephen's talked about. It's balance sheet assets, capital intensive industries, broadly defined infrastructure. It's the easiest investment theme to call your shot on, because these are necessities. If we don't, everything else isn't going to matter, and you're just going to be stuck with short-term trades that are going to have you chasing your tail, and you might as well do meme stocks as a trade, because they're highly predictable in the behavior and the outcomes. But I think that Stephen's work is spot on, and if you can't make a case against it, and most importantly, when you look at trying to make that case, you realize just how urgent and obvious that sort of capital intensive, balance sheet rich industries, largely targeted at various infrastructure things. And then the issue of productivity gains is absolutely critical. If we don't get that right, we're screwed.
We do have to fix the population side too, Joe. You can't have a continually declining population and get there, even just on productivity alone.
I completely agree with you. We're talking about, the optimal strategies, But the magnitude of the return on those strategies is absolutely going to be defined by the demographics. And that's not something you change a return on a dime. Look at Japan, look at China, look at Germany, look at all these other countries. That's one which is the bad news, is that that's just has an inertia that is highly predictable. And so again, that's how you calibrate expected returns. But where you're going to get the best risk-adjusted expected returns, the absolute returns are going to absolutely be fueled by the demographics and the productivity gains, which are also going to be hard given those demographics and the average age, et cetera, et cetera.
And both factors, productivity and immigration, will be on display in Palo Alto. So I would, to your point, Bill Deichler, can we grow out of this? Do we have the innovation productivity gains? And that's what we'll be discussing on the West Coast. And you'll hopefully be highlighting some of that on your survey 16.
Good, duly noted. So two super quick points. The chart that I showed back not too long ago, where on an incremental dollar of debt, we're only getting 43 cents worth of incremental GDP increase. That's a not, even if that number isn't 43 cents, if it's anywhere close to it, it's bad use of capital to increase taxes, from that perspective, and probably best to free up more capital within the private sector. And then the second point I wanted to make, going back to Roger's question, was that the only two times I recall on the stats is the Clinton compromise with Newt Gingrich and the tax cuts that came out of that. That was very positive for the economy. And then if you look back immediately post World War II, we had huge deficit at that point in time, and we were able to grow ourselves out of that, primarily because the government spend didn't increase any further from there, and the economy boomed. But needless to say, I think, both of those live in environments that we don't have right now. But nonetheless, it does show that it is possible. It is possible. Tough, but it is possible.
Other comments, questions?
Mark, I have one fun fact for the group.
Fun fact.
And it gets to the population issues. In the UK in 1965, the most common age of death was in the first year of life. Today, the most common age to die is 87 years old. In Japan, he notes that a newborn girl in Japan has a 96% chance of making it to 60, while Japanese women have a life expectancy of nearly 88 back at that time. So now we're living in a world where life expectancy is 76 for women, 71 for men. This is clearly on the rise now of where we have different problems that come with this that we really have to think about a lot differently. So the longevity themes that you're highlighting have different elements too, not just how do we live there healthier, but what does it mean for us economically to support that kind of a system? It requires a different mindset than our politicians have today. Thank you guys for joining. Appreciate it.
Any other questions before we break? All right. Oh, Andy Voss, last question.
Hi, Stephen, can you hear me?
Yes.
On the tax cuts that are sunsetting, what was that total figure?
Well, all the legislative changes is 2.6 trillion. I'm not sure what the tax element of that is, but it's, I think it's at least 1.7 or 1.8.
And that includes, would that include the inheritance and the state sunsetting tax?
Whatever they're looking at. The CBO just takes all the things that are going away and pops them into a number.